Thank you, Shane. And now I would imagine for the alternative view on the alternative view, we have Michael Hayes, Investment Sales Manager with Irish Life Investment Managers. Michael has, it tells me, 25 years plus experience in the investment management field, both with Canada Life and Irish Life. So, ladies and gentlemen, Michael Hayes.
Thanks, Alan. It's absolutely not 25 years, I can assure you. It's less than that, I'm glad to say, but more than 20. Just thanks a million, Alan, for giving us the opportunity to talk to you here tonight. And thank you for coming here to listen to us talk about ourselves. I'm not going to contradict Shane in any way. He makes perfect sense. But what Alan asked us to speak about today was a range of funds that we have called the multi-asset portfolio funds, the MAPS funds, that we introduced 5 years ago, and probably now would be recognised as our sort of flagship investment offering. So they're 5 years old, just passed a couple of weeks ago. They've been very successful for us, thankfully, and we think there are good reasons why long-term investors should look at investing in this type of approach, which is basically a multi-asset approach where you invest in a lot of different asset types, different strategies, different styles, different geographies, to give you a wide range of diversification, but also importantly that the funds are managed to specific levels of risk that you're comfortable with taking on, and that those levels of risks remain fairly consistent over time as well. Hopefully most of you are familiar with Irish Life. I think you would be. You may not be as familiar with Irish Life Investment Managers. So Irish Life Investment Managers manage about 70 billion of assets across the group, across a range of different clients. Of the domestic managers, Irish Life would be the biggest one by assets. Thankfully, we have a lot of very happy clients. We would manage, of the top sort of pension schemes in the country, of the top 30, we'd manage about 23 or 24 of the biggest ones. Well-known names, the likes of An Post, ESB, CIE. In terms of multinationals, we also would have a lot of their pension schemes, so companies like Dell, like Apple, like Microsoft, like Google. We manage the pension schemes for their employees. So just by way of background of hopefully establishing our credibilities as an investment manager. So it's a very diverse and prestigious client base, and we're part of a bigger group. The group is called the Great-West Life Company, which is one of the biggest Canadian insurers. A very strong parent company behind us, bought the company 5 years ago, 2013. And they've been a big investor in our business, helping us to grow, particularly on the investment side with the likes of the MAPS funds we have here today. So really the MAPS funds I mentioned, 5 years old. When we talk about MAPS, we talk about really delivering on these key objectives for investors. And really what we're trying to provide in any pitch that we do, we talk about these things as sort of the four key pillars of why you should be interested in investing in these funds. What we're trying to provide is choice. So in the insurance industry or in the investment industry, there's a scale now used of 1 to 7, 7 being the highest risk. We're covering off 5 of those, so really from 2 to 6. If you're at 1, you're pretty better off talking to the team about a deposit. And if you're 7, you might have your own portfolio of different assets. So we're covering off between 2 and 6. So we would hope that the majority of people, there's a choice there for you within that range for some of your, if not all of your investment. To us, what's critical to these funds is managing risk and making sure that the risk that we're taking is commensurate with the risk that the investor wanted to take on. So if you're down at a risk level 3, we'll take the level of risk we think is appropriate for that sort of investor. If you're up at 6, the same will be the case. And over the last 5 years, markets have been very strong. Returns have been very strong for MAPS and for Aviva's funds and other funds that are out there. But risk is an integral part of what we do, and we're continually concerned about risk and what can go wrong, what might go wrong, and trying to minimize risk and trying to particularly reduce losses basically within the funds when you have those periods that obviously Shane talked about, when you have those periods of falls in markets. Ultimately, because of the diversification in the funds, we're trying to generate smoother returns over time. We're trying to iron out the big peaks and troughs that you tend to have, and particularly in equity markets, by the diversification and the risk management within. And then the peace of mind, we can't promise that, but we hope that you'll, understand and believe that we're a credible manager, doing things in the right way, and also that, performance is really an outcome of what you do, but it's the process that makes it repeatable. And I hope you understand that our process it's a very robust process, a very repeatable process. If you're just buying into the funds today, the past performance isn't particularly relevant for us. We're concerned about the future performance and trying to maximise that as much as we can. So these are the funds we have. So from covering off from 2 all the way up to 6, and you could say that the multi-asset portfolio 6, which is 90% in equity markets, covers a sort of a 7 level of risk as well in terms of investors. The majority of our assets in the MAPs, so we launched them 5 years ago, there's about 4 billion of money that's coming in through retail investors like yourselves. There's about 11 billion more broadly, including our own staff pension scheme, is invested in MAPs. Really just putting our faith behind what we think is very much our best thinking in terms of investments for clients. So these are, again, the 4 pillars. So you have the choice. The smoother returns really comes from diversification. We're diversified between assets, so we've equities in there are bonds, there are property, there are absolute return type strategies as well, but also within each asset class. So in equities we have 4 different strategies, in bonds we have 4 different strategies, property is our own well diversified commercial property fund that we manage with about 60% in office, the rest in retail and industrial properties. We're also investing in both our own funds, the majority we manage in-house in Irish Life, but we also select external managers in the absolute return bucket, or we call it alternatives, similar strategies to what Shane was talking about. So in those strategies, we don't have in-house expertise in those strategies. So what we do in that case is we go and hire other managers who are very specialist in this area. It's particularly an area where skill is to the fore rather than just investing directly in markets. So we hire external managers in that piece. And within our MAPS portfolios, there's about 20%, 22%, which we allocate to absolute return strategies or alternatives. So you're also invested in different fund managers, different styles, different currencies, obviously, different geographies. And we have a number of sort of unique strategies within. One strategy is an option strategy, which is an equity-like strategy, but has a level on the drop if markets fall, and you continue to kind of pick up a premium for that. So there's different strategies within there. Risk management to us, it hasn't really been that important, to be perfectly honest, over the last 5 years when you could have bought any sort of asset and it went up. But we're always concerned about that, and there's a number of ways that we manage risk within the funds. One way we do it is we have this annual review where basically we sit down as a team, we look at what we're investing in across all the MAPS funds, and we say, are there things we're not invested in today that we want to invest in because we have a very positive medium to long-term view on that investment? Are there things that we want to take out, areas that we don't want to be in? Do we want to reduce the risk in, say, the bond portfolio, invest in other areas of the bond market if we're concerned about interest rates moving up? So that's the annual review that takes place. Also, at that annual review, there's constant tweaking. So we try and improve the funds all of the time through enhancements, improvements to our process. There are basically sort of 2 principles that govern us at annual review time, and they are, can we increase the expected returns in the future, or can we improve the risk management within the MAPS funds? So those are the 2 principles that guide us to make changes, and sometimes there won't be changes, but we're continuing to trying to evolve the funds and trying to improve them with enhancements that we're building in-house with the skill set of the people that we have in the office. DSC there is a model whereby we basically look at a range of inputs, a range of factors, a range of data, where we will, based on that, based on how bad it gets, we can use that as a way to reduce equity exposure. So when you have big drops in markets like 2008, like 2000, really the only way to protect capital is not to be in equity markets. So that's just a way that we can reduce our equity exposure. At times we feel you're going to have a particularly protracted sort of drop or drawdown in markets. Currency hedging is something we introduced 2 years ago, and then we enhanced it in the annual review last year, where we have this dynamic model where obviously we're investing outside the euro. We look at it every single month, and then we decide if we want to hedge or not. So rather than having this static hedge where you just don't move, it's a dynamic model that moves as you go along. Low volatility are basically shares where we're trying to find shares or equities that are less volatile than the broader market, but also exhibit very good characteristics when you have market falls. And we're not just looking at volatility, we're looking at a range of factors to try and screen out the less volatile stocks, but also the ones that tend to do better over time as well. The last thing then is the performance, which I'll touch on at the end. So this is just what we invest in. So if you come to us, or if you're already invested in MAPS today, these are the investments that we make for you. On the left-hand side, you can see they're the asset classes that we're invested in. Basically, all of the MAPS funds invest in exactly the same assets, just the percentages will vary. So as you move to the right, to your right, you're more in equity markets, and obviously on the left-hand side, you're more in defensive type assets, but the underlying building blocks are all the same. So the point I was making about diversification is that, for us, it's important to diversify with different types of asset, but also in the asset. So in equities, in the majority of the MAPS funds, there are 4 different strategies. So emerging market shares, these lower volatility shares, more defensive type shares. The All Country World Index is basically an index of the major countries of the world, including emerging markets, which is about 10% of the overall index. So you're getting good exposure. It's a passive index style within these strategies, so you're getting full exposure to all of the companies that are in that index across the world. Equity option strategy is a unique option strategy where we're getting a return for writing options, and that feeds into that portion. So it's equity-like returns, but with a lot less volatility. Then in bonds, the same is true. So it's about diversification. There's 4 different bond markets that we have there, whether it's company bonds, government bonds, emerging market bonds, and also some high-yield bonds in there. The alternatives is the 22%, and then as you move across, there's less in alternatives. There's more exposure to direct long equity assets. But the alternative strategies would be similar to what Shane was speaking about there. So it's absolute return type strategies. And these are, absolutely echo Shane's point that they're critical to a portfolio, to making it more diversified. And a lot of these strategies can absolutely make you money when markets fall. There are different strategies in there. They might be following particular trends, and they can make money from those trends. And it doesn't matter if the trend is up or down, or if economies are growing or contracting, or if Italy's blown up. These are strategies that can really be a good buffer within a portfolio. The other thing there is Irish property. We would manage about 3 billion of assets in Irish property across the country. We recently made an investment in residential property, which was our first investment in residential property, where we bought in a block of apartments in Churchtown, but it's primarily commercial property. It's primarily prime. So excuse anyone from outside of Dublin, but it's primarily Dublin, and it's primarily prime property. So it's primarily Dublin offices, and in terms of retail, it's assets that would be Grafton Street, Henry Street, the Pavilions and Swords, the ILAC Centre. So it's sort of prime assets rather than more peripheral assets, and property is something that we've been doing very well for a number of years. And again, it's a good diversifier in a portfolio, but it's prudent to have not too much in property. The last thing there is cash. So there's some cash in 2 and 3, and then as you move out, there isn't cash in the other MAPS funds. So just in terms of some of these I've already mentioned in terms of risk management, just to give you an idea of some things that we do in the fund. So the strategic review is once a year. It's a sense check. Can we make enhancements? Can we make improvements? Can we invest in other assets that we're not in today that we have a good prognosis on for the future, or good outlook? The next thing on the right there is really important, we feel, and it's basically what we call rebalancing. So these are what you invest in. The weights, the bolded weights, are the asset class weights. So they'll move up and down as the assets appreciate or fall in price. So all we do is we just bring it back to what we think is the right level. So those bolded weights, we'll bring that back to those weights at the end of each quarter. So if you look at MAPS 4, if it's 60% in equities, If you have a super quarter, it's now 62. We'll bring that back to 60. We'll bring up the other ones back to what they should be at. And the importance of that is that rebalancing has a really fundamental effect on your portfolio. If you don't do that, your fund can become quite different to what you signed up for. If that happened over a number of quarters, you could theoretically end up with, say, 80% in equities. You signed up with Alan and the team at 60% in equities. That fund has become something fundamentally different to what you wanted. So for us, rebalancing is critical for maintaining the level of risk in the funds. And we do that every quarter within a portfolio. It's not something you have to do or the team of Finance One have to do. It's automatically done in your funds. Diversification, hopefully I've talked about that a good bit. There's a huge amount of diversification within the Irish Life's MAPS funds, whether it's by manager or strategy or geography. Currency hedging I mentioned, it's important. Obviously, we're seeing fairly significant moves in the euro recently, so that is important. It can work for you or against you, but again, we think it's a risk that you can eliminate from portfolios or partially eliminate from portfolios. Low volatility is the more defensive equities, and this dynamic share to cash is just something when to reduce big market falls by reducing your exposure to the riskiest piece of the MAPS funds. So over the last 5 years, this is just giving you an idea of the performance. So the performance since launch up to a few days ago is at the bottom. You know, absolutely granted, markets have been strong, but the returns of the funds haven't surprised us based on what we're invested in. So we didn't do better than we thought we would do. We've done what we thought we would do based on what markets have done. On the top there is just some, we're going through worries about Italy at the moment, and obviously in the bond market, particularly on Italian bonds, and whether there's a bigger sort of existential crisis for the euro or another one going on at the moment. But these are some of the other things that in the 5 years MAPS have been out that we've managed to weather and still deliver strong returns for investors. I suppose the point being is that there will always be some sort of event out there. You know, absolutely these funds are for longer term investors. If you're looking to make a good return in a year or 2 years, these funds shouldn't be for you. You have to have a long-term approach. But some of the things we've managed to weather, whether it's the surprise Brexit, the surprise in the US, although it was close all along, or other worries, the recent fall in markets in February. Thankfully, the funds have managed to generate strong returns. These are the returns over 1, 3, and up to 4 years. They were done just before the 5th anniversary. So, look, for us, the returns are fantastic. We're delighted. Our investors are delighted, absolutely. But it's about making sure that we can continue to deliver returns. It's about making sure our process is absolutely thorough, is repeatable. Can we improve it? And to be perfectly honest, those returns, are at the higher end of what we would expect from these type of funds. Markets have been really, really strong. A bit like Shane, we are still positive on markets. We think returns will still continue to be good, but I would just say the returns are probably ahead of what we'd expect over sort of longer periods, albeit heartening for us. Hopefully we're doing some of the right things. Then the last piece is just talking about, you might have heard our ads. We've just launched another ad campaign. Paul, where are you? We were complaining about the ads earlier. There he is at the back. He said he's sick of hearing them. But just to give an idea, some of the things we're doing in terms of press and radio and videos, there's a load of stuff on our website that you can avail of as well if you want to understand more about the funds and how we manage them, and some testimonials from clients. So that's it from me. Just to thank you all very much for listening on this beautiful night.